and welcome to the Pot of Gold. I am your host, Shay Russell, and today we are doing something a little different. We are coming from the RIU Sydney Resources Conference in 2023, and I am here with one of my absolute favourite people to speak to, Nick Frappell, Head of Institutional Markets for ABC Refinery. Nick, how are you, mate?
Extremely well. I've just come off making my presentation here. So like you say, it's sort of a little bit of adrenaline and feeling happy.
Look, dare I say it, that is probably one of the best presentations of yours that I've seen in recent years. And we're actually going to try and touch on some of the key points that you managed to get through in that presentation. First and foremost, I want to talk about gold. Now, we're going to skip silver today. Silver has no place in today's conversation. But let's talk about gold. We've got gold back up above $2,000 per ounce. And without giving away the conclusion of today's podcast, you put out some very bullish forecasts for the gold price up on stage today. What is the driver behind those?
I think there's a few drivers that I mentioned. They're not all kicking in together, but one of the main drivers is that we're seeing a sort of secular decline in the dollar, having seen the dollar index at least peak around about September of last year, which was kind of interesting because we've had talks about the dollar for the last 2 years at the RIU, and I think in 2020 I did say something about cycle and positioning suggesting that the dollar would move. Went a little bit further than I expected, but I thought it would go to something like 105 in DXY terms. But now we're on the down leg, we're on the down slope, and I was talking about the dollar. I had a vague target at like 94, 96 in DXY terms, and the point and figure that I look at a lot, as you know, there's a target there to sort of just over 94, and I was talking about that panning out in I guess H1 2024.
Yes. Actually, it's interesting that you do reference your dollar conversation because we did talk about your bold predictions for the US dollar and how high it was going to run, or the US dollar index, this time last year, and you turned out to be correct.
Yes, like put that in your diary. I was correct.
So all the more reason that this is the most important podcast you will hear this year. All right, Nick, let's go through a couple of key parts of your presentation today. Now, one of my favourite parts was perhaps your central bank talk, but not in the traditional ways we talk about the official sector buying gold. You laid out some pretty compelling reasons on why central banks have been buying gold. And can I get you to tap into that information now?
Yeah, absolutely. Look, there's been a lot of talk about, the tremendous amount of gold they bought last year, which was, it'd be interesting to see if that's an outlier or not. I suspect it will carry on. But one of the conversations, if you look at central bank reserves in their totality, is how much they've grown in the last 30 years. They've grown something like tenfold. Once you hold above a certain level of US dollars, which is the ultimate sort of go-to currency for official reserve holdings, you then end up in a situation where you've kind of covered the insurance element of your official sector holdings. You've covered the precautionary element. And then beyond that, you kind of ought to rationally diversify, right? Because otherwise you're just paying for insurance and you've got an overholding, if you like, of the US dollar. So it makes sense for other assets to feature, and it makes sense for gold to feature because the gold is either negatively correlated or not very well correlated to a whole bunch of other things. So and it has no counterparty risk. So gold's very, very attractive from that point of view. The point I was trying to make, though, which you picked up on, was that this is not about de-dollarization and it's not about a rejection of the dollar, because if you then take a step back and you say, well, how many dollars did central banks, the official sector, acquire last year whilst they were acquiring gold? The amount of dollar-based assets, so that, like treasuries and agencies that they picked up last year, is huge. And I just wanted to make that point to the sort of the audience that because quite a few of them would quite easily walk away with the idea that every time a central bank buys gold, that it's some kind of rejection of the dollar. It's nothing like that. It's much more nuanced and so on. You're seeing a lot of buying of treasuries. You're seeing a lot of ownership of agencies like national, Fannie Mae and all that sort of stuff, Freddie Mac, sort of so on type bonds. And the two I did single out, fairly or unfairly, two central banks that on that slide have actually bought more gold, or in fact even been net sellers of U.S. treasuries and they were Egypt and Turkey.
Yes.
And fairly or unfairly, did make the observation that these are not like the go-to banks or the go-to sort of entities for, um, you know, sound policy making, whatever. They are in a bad space for a couple of reasons, and therefore, this is their pathway is not the pathway you necessarily want to follow. But that was my point. Yes.
No, it was an excellent point, and I think I've got some quotes scribbled in horrific handwriting that I can't even read back to you. But as you said, the key point of talking about the official sector increasing their gold holdings points to diversification, but also to, you are right, in that excellent chart. And we'll try and see if we can make the PowerPoint presentation available to go with today's podcast.
Yeah.
Because that was a really interesting chart you showed where, yes, there's been significant movements into gold, but there's been also very significant movements into dollar-denominated products.
Yes. Yeah.
Now, jumping back a step, because what I forgot to talk about, again, this comes down to my chicken scratchings that I've got in front of me, is the bank stress that the US is seeing at the moment. Now, you touched on a couple of examples during your presentation. With the gold price remaining elevated at this point in time, do you think the US banking stress is impacting gold at the moment?
Yeah, it is. It's not easy to draw a straight line between one and the other, in a highly mechanistic way, but it is, and I'll just sort of say why I think it is. Firstly, when Silicon Valley Bank and Credit Suisse and now First Republic, all facing their problems, close downs, mergers, effective bank resolutions, you name it. Those had an immediate impact on the expected pathway of US policy rates, and they also had a change in the expected pathway even of Australian policy rates, even though Australia is, relatively speaking, remote from those problems. It's an entirely different banking sector and so on. However, that's the first thing. So the expected pathway of rates, which if we cast our minds back to, say, February, there were people talking about the Fed funds going through 540, 550. Even some people are talking about 6% on the Fed funds rate. So it was really, really strong. Again, this was after a lot of hot data from America. So people were expecting higher for longer and a lot higher. And then that was a profound pivot early March, and you started seeing stresses in the banking system. And the move, even if it was perhaps overdone, but no doubt about it, the move in the expected pathway, which is derived from future strip of US policy rates and policy rates elsewhere, was large and profound. That was good for gold, and remains good for gold, and has all kinds of other things baked into it, because it kind of makes you ask, okay, if the pathway is downwards, then unless we go into some kind of contraction, recession, whatever you want to call it, has inflation been dealt with? And then that obviously goes back to gold as well. That's one thing. The other thing is that some of the policy responses from the Fed to try and deal with the supporting the U.S. banking system is basically like akin to QE. So banks can pledge all kinds of eligible securities to the Fed, and the Fed will lend the money at OS plus 10 basis points, which is a fantastic rate. And the important thing about this is it doesn't matter how impaired the assets are. The assets could be worth 50 cents on the dollar, but the Fed will treat them as though they're worth 100 cents on the dollar. Now, one of the charts I showed that up to about 2 weeks ago, I think, I might have just skipped one of the data points, but going back 2 weeks ago, in the space of about 8 or 9 weeks, $81.3 billion was extended by the Fed under that new bank term funding program. The other element which I wanted to mention about, bank world and what that means, what bank stresses mean, is that even before headline news about Silicon Valley and all those other banks and all those fears, the Fed does a quarterly survey, or it's sort of published quarterly, and looks at what senior loan officers are doing in U.S. banks and what their approach is to lending money. And are they getting tighter? Are they getting more constrained, more constricted, or are they easier? Even before this kind of bank news hit the headlines, there was a sharp uptick in financial tightening, financial conditions of financial tightening vis-a-vis the senior loan officer survey. And my point, sort of which I sort of waved the laser at the chart, was that given that there's been more bad news since, I would take it that the senior loan officers are going to be even more negative or even more cautious about how they create assets in the banking system. And that's coming from their sort of economic outlook, but also has to be seen in the context of banks need to bid for liabilities, i.e. deposits. Banks need to bid for deposits in order to prevent them from migrating into, say, T-bills or money market funds and so on. So you're talking about a tightening of financial conditions, and those two things should help gold, because tightening of financial conditions may hurt other asset markets, and gold, may benefit, relatively speaking.
Yes, you did raise an excellent point up on stage, and that is it's a QE coming from the Fed up against basically the private sector
Yes.
tightening market conditions.
Yeah.
While I've name dropped the Fed in there, let's talk about our favourite subject, or second favourite subject, next to gold. You made an excellent point during your podcast. I'm starting to sound like a fangirl. I think I've said excellent point 3 times.
I know.
I promise I'll have a thesaurus for our next podcast. I want to talk about Taylor rule when it comes to discussing rates. Now, the comment you made, let me just fold this bit of paper, rates are not as tight as the market thinks they are. This is a really important point, because what you were demonstrating up on stage is that as a result of Taylor rule, which you pointed out that the Fed does follow in parts,
Yes.
Policy should be tighter than it is, and that in your view, policy is rather accommodative right now.
Yeah, and look, I said that on stage. Actually, I said this was certainly could be viewed as a really simplistic point that I was making.
Yes, please elaborate here. I really want to drill down into this. I think this is an important context in the central bank market or Fed rate market.
Central banks use a lot of things to guide where policy rate settings should be. But one of the perhaps enduring things that they've used probably since early 90s, I guess, and this has been a big part of their the trend towards central bank independence, which I guess is another different subject, is can they follow mechanistic rules that kind of spit out where the policy setting should be? Fed funds, official cash rate, whichever country you're in. That if you put in growth and various things, it might be a complex looking equation, but you should get a policy rate setting that allows for growth, employment, and inflation settings to all be roughly, kind of like where those areas where, let's say, to take the Fed as an example, 2% inflation targets, all of those things kind of come together. Now, it's not the only thing, and I'd make the point as well that there's an asymmetry in the Taylor rule, because central banks have been very quick to ease when the Taylor rule has suggested that their settings can be eased, but they have not been quick to tighten when the setting suggests that now is the time to tighten. And that perhaps tells you something about the difficulty of central banks doing what they're doing what they do, and the difficulty that they face in the face of real world sort of political and social pressures. Nonetheless, they ease quickly and they tighten slowly. Except for last year, because it was suddenly like, oh my God, like we have to tighten. But my point is, simplistic or otherwise, that if you look at the baseline Taylor rule settings and where it suggests policy rates should be, and I know there's a whole literature of economics that says, well, it's a bit more complicated than that. Fair enough. Those settings are much higher than the official policy rate settings, certainly of the Fed, certainly the RBA. And it's just worth, I think, pointing that out and showing what that gap is, so that people who sometimes think, and there's a lot of discussion around this right now with the RBA, has the RBA tightened too much? Is it all horrible? Call it what you will, but the point is, judging by the Taylor rule, the RBA has scope to tighten more. And I guess that was something I wanted to make clear. Now, where does that tie back into gold. Ties back into gold because if rates truly are accommodative, in sort of real policy rates are truly accommodative, then there's a risk that we don't get on top of core inflation if growth carries on and there isn't a slowdown, that we don't get on top of core inflation. And one of the points made by sort of another person that I won't quote directly, but they made the point that services inflation has been quite persistent, and services inflation certainly isn't very responsive to tightening. But generally, I mean, let's sort of step back and just say that that if rate settings are accommodative, then perhaps we don't get on top of inflation quite as quickly as we hoped. If they're tight enough to prompt a recession because of, the sort of household balance sheet debt, pressures on spending and so on, then inflation will go away. But it'll go away mainly because the economy is slowed right down. So there's the whole thing. I mean, right now the U.S. economy is looking pretty hot. The last data point for non-farms was good. I know the prior two were revised downwards, which took some of the sting out of that. But ISM, labour markets, earnings, plenty of beats on all of those things. And what looks like at the very basic level an accommodative monetary policy setting, inflation all of those things may keep people looking at gold.
I want to just sort of summarize what you've said, because I really want to drill down into this point. As you said, some people might say it's a simplistic way of looking at it.
Yes, yeah.
However, I feel what you're really drawing attention to is your blind spot. It's that, prior to, I think about 6 months ago, this was not something that was commonly talked about. And since you've brought it to my attention, I've seen it a couple more times around. But pointing out that policy is accommodative rather than tight differs from the headlines.
Yes.
And this is a really important point to drill home, that it's actually, rates have been a lot higher than this for longer periods of time.
Yeah.
And the Taylor rule is pointing that the policy's not matching the talk.
Yeah. And maybe if you look at example like Australia, because it's our home market and it's one where we should be more familiar with, or we have some familiarity with.
You'd like to think.
You'd like to think, but maybe the answer that's hidden in plain sight is that rates have been higher, but last time rates were higher, households weren't so leveraged up. And now that rates are going higher, but the degree of household leverage, the household balance sheets are way, way higher. Of course, the Taylor rule doesn't necessarily take account of that, or I don't believe it does. So maybe that's part of the missing piece.
Yes.
Is the degree of leverage in the system, and the fact that rates as they are, of course, can have profound effects being transmitted through an economy where household balance sheets and corporate balance sheets are much more leveraged than they were in the past.
Now, flicking ahead a couple of pages on your presentation, I want to talk about what you so cleverly pointed out as a potential to be a grey swan event.
Oh, yeah.
Love the turn of phrase on this one. And this is the US debt ceiling, the impact that it might have for gold.
Yes.
Can you run us through your points on that one?
Sure. And I'll start with grey swan because, everyone knows there is a US debt ceiling. So it's not like a black swan where it was like, whoa, where'd that come from? But the point is, it's kind of a grey swan because we don't know all of the, we assume that the US debt crisis, the US debt ceiling will be resolved. But there's nothing that says it must be or has to be resolved. It could fail to be resolved. Sincerely hope that doesn't happen.
I think you called it, what was it?
It's not impossible, but it is unthinkable.
That's it.
Yeah.
Thank you for dusting that out again. Very impressed.
I ad-libbed that one, as I was saying.
I couldn't write quick enough. Sorry, please continue.
Yeah, so what does it mean? Well, I guess from a narrowly gold point of view, the Fed has to look at liquidity provision measures in ways. It has lots of ways in which to try and prop things up, keep things going, which it absolutely must do to the best of its abilities, whilst the debt ceiling sort of is hopefully being resolved at the political level. Some of those things will result in lower nominal rates and will result, you'd expect, in a kind of an economic shock of some degree that would reduce growth, and that those kind of negatives, if you like, would be positive for gold. Also, the degree of uncertainty around, for example, US debt issuance, and the fundamental problem, or the fundamental reality of, or fear of, default. Those things again highlight an asset with no counterparty risk and diversification benefits. So that's why I would say the debt ceiling problem has the seeds of, it's a positive thing for gold, but the ramifications of not sorting this out are too widespread and too manifold. They touch upon too many things that there's no good answer. And I can understand exactly why, in the political horse trading to try and figure out getting this problem solved, there needs to be a kind of an understanding of where spending can be cut and where taxes can be raised, and all of those things that matter. But in the end, that issue has to be resolved for the longer term, not just, hey, we'll do some horse trading that gets us through June, July.
It feels like every 24 months we're having the same conversation about the US debt ceiling. There's no forward thinking here. It feels like it's been all very short term. Horse trading, actually, basically, to put it the way you did.
Yeah. I mean, look, it'd be really great to have somebody on the podcast who was really, really well versed in the ways that the Congress makes law. One of the problems is that somebody, a very, very smart friend of mine, once explained, and I hope I'm not butchering his explanation to me. But one of the problems is that when laws do get passed through Congress, all sorts of other things can get tagged onto them. So a law that might be to do with, I don't know, it could be to do with the environment, or it could be to do with, I don't know, safety issues or machinery or something. And then somewhere in there, but in the horse trading that takes place to get it through both upper and lower houses, something will get tagged on that might be a spending boondoggle, or might be a tax cut, or something that affects somebody. And what that tells me is that there's only a piecemeal policy-making agenda about tax and spend, and what you need is a wholesale approach to it. And you've got a really, really sharply divided, two sharply divided parties. So getting them to talk about things that really go to the epicenter of what America wants and needs is super hard.
Look, I know you're not an expert on this matter, Nick, but that is an excellent summary, so I do appreciate that. Two more questions now. You and I will probably go through your presentation page by page. It really was quite riveting. But I want to...
Sorry.
Hey, people wanted to ask questions at the end of it. It
They
wasn't
did.
just
You're not supposed to have a Q&A, and people were like, no, we want a Q.
They did.
Yeah.
All right, I do want to talk about the Bank of Japan ending yield curve control. Now, this is something you brought to our attention towards the end of last year, so this has sort of been a passionate topic of yours. Again, that isn't picking up a lot of traction unfairly when it should. So I'll get you, if you don't mind, to summarise that last slide when you brought up the Bank of Japan's recent policy change.
Yeah. Well, actually, in terms of policy, the BOJ has been trying to sort of carry on with YCC yield curve control, but the issue is the point of the reason why YCC has become such a hot topic is partly because the band widening in December, and also partly because rising. I mean, it rose and then slightly fell, but the trend is up. Rising Japanese CPI and then wage settlements are gradually making, at some point, yield curve control at the level it has, for 10-year bonds isn't tenable. And the question is how smoothly the Bank of Japan can exit this policy without disrupting a market where they own, kind of all the bonds, as it were. In fact, in some tranches, they own more bonds than were actually issued, because some people shorted those bonds, and the BOJ bought those bonds too. So now there are people who short the bonds that they don't own. Yes. It has all the makings of a proper, a real. Trying to think of a word that isn't kind of Anglo-Saxon here, but a real problem. Anyway, the new Bank of Japan Governor Ueda has pushed this sort of problem along, and for the time being, certainly can. And I think there are two reasons why, which I mentioned. One reason is that the disruption caused by a shift in yields, especially if it was a little bit uncontrolled, would have ripple effects through banks, life insurance companies, and so on, and could lead to some, pretty significant write-downs, depending on the shape of the curve. If it moved, it's likely to steepen rather than anything else. But if it moved like as one piece, that would have a big impact on bank equity and certainly some medium-sized banks. So having seen evidence of how steepening, or I should say the yield changes in America damaged assets at US banks, I think he's really keen to avoid that in Japan. So I think what will happen, I think banks, some analysts have thought and made some very cogent cases for why it would happen anytime now. But I think they're trying to hold it off. And why does it matter? I think it matters partly because you could see an echo of what's happened in America in terms of some bank concerns. I don't know if that's that could happen. And I think you might see a high yields translating into a higher yen, and that could be, all other things being equal, positive for gold, certainly weaker for the dollar index, and it would be part of the dollar index weakening story that we talked right at the beginning. So, look, it's how long is a piece of string? I don't know, but is it one of those things which contains significance? Absolutely. And when does it happen? I think that the BOJ is probably thinking long and hard. They don't want it to happen anytime too close to now. But when?
But when?
Yeah, exactly.
Now, Nick, unfortunately, I've managed to, well, fortunately for me, unfortunately for you, I've taken up nearly half an hour of your time. So our time is drawing to a close today. So I'd like to end with our key takeaways from today's podcast, the message you'd like people to receive. Now, from your presentation, I loved, you're not often so overtly bullish for gold. You're really not.
Yeah.
And that was where you ended your presentation today. It was you're a trader at heart. So it doesn't matter which way you go with the flow.
Yes.
So for you to end a presentation so overtly bullish, and I've got two of the three brilliant things that you said. See, I found another word. The market disruption and anxiety for other assets. You've put out not just some bold long-term price forecasts, but overall, these two factors, the market disruption and anxiety about the impact on other assets, are building a strong case for gold to rise this year. Tell me, to bring the podcast to a conclusion today, what do you believe is your key take-home message for everybody?
I think the really important thing is we've had 3 attempts at 2075 in US dollar terms now. Now we got to about 2060 before falling back just a couple of percent, roughly, 2-3%. And then we're now, last time I looked, we're back above 2020. That 2075 level is key in US dollar terms. The targets that you're referring to, which I derive partly from a potential break of the double or triple top, whichever way if you want to call it a triple top now, but certainly it's been a double top up to now. And the point and figure charts that I both rely on and love suggest a move. They suggest a move, and they move on the bearish case as well as the bullish case, just in case people are wondering about that. A break of 2075 opens the path to, obviously 2100 is a sort of, there are targets there, but that would be no surprise on the initial break because there'd probably be some shorts stopped out on the initial move. But actually the price structure that we've seen evolving over the last few months, since they moved from the last year's latter part of the year's lows, that suggests moves right up to 2,450, 2,500. So, and that's consistent with the break of that double top as well. So, I'm not often bullish because I like to think of myself as steadfastly Swiss in all things price. but I think price related. But I think that there's powerful macro themes here. There are powerful macro risks, and that a move through 2075, which is so important. And I guess you're hearing that I think a lot of it's contingent on that price break, can resolve upwards to that extent.
Nick, this is an incredible place to leave a podcast today. I love a podcast on the fly, especially when we can't make
This is
any
a cool
edits.
way to do it. Yeah.
We can't make edits. What you hear is what happened.
Yeah.
Nick, it was a pleasure hearing you speak today, and it was a pleasure to be back in the booth doing something at a conference. I always love it when we do this, but I've got to say, good fun. And I will try and obtain a copy of your presentation so we can send it out when we get this podcast live.
Cool.
Go to the website, abcrefinery.com.au and /media, I believe you'll find it under.
No.au.
No.au.
Sorry.
I'm employed for one reason, and I can't get that right.
Only saying that because we can't edit, so I have to get that in.
Please listen to Nick for information, not me. All right, Nick, I'm going to close now. This has been great. Thanks very much.
Thanks, Shay. It's brilliant. Lovely.